And today, the topics sound really technical, but it's actually so good to know. And I had done this type of explanation for many times in the past. But today, I thought through it really carefully. And I say to you that I want my accountants at Community CPA to really listen to this webinar because it gives you the most important knowledge related to that. And through the pandemic, and we all know that financial statement is even more important than before, right? Every time you turn around, you want to apply for PPP, they ask you for financial statement, right? Then you turn around, they ask you for financial statement for RF. Then again, on tax return time, how many times your tax preparer was like, hey, can I have your financial statement? Then you go, what do you mean? Can I give you the bank statement? That's not the same, right? So in this 60 minutes, I'll give you that knowledge and make you an expert to read and understand financial statement. When people ask you for that, if IRS come to audit you and they're asking for your financial statement and you know exactly why they're asking, what they're looking for, then if you're going to the bank to get a financing requirement, like to apply for a loan, and the bank asks you for financial statement, and I want you to know exactly when you present that financial statement, you know what that does to you. So let's just get going. And I, of course, I give you what my knowledge is and give you my understanding of the business and of the financial, but I also want to make sure that that doesn't replace your own responsibility. So we like to make that no responsibility disclaimer to our webinars. So now let's just get going with the financial statement. I want you to look at this one slide because this is the one that I want you to see. And then I will soon change screens to something that I drew for you. So every time when someone talks about financial statement, and they say, hey, give me your financial statement for your business, they're talking about three components. One is income statement, balance sheet, and the cash flow. And in most of our clients, and our clients are typically business under 100 million and small businesses. If your sales is under 100 million a year, and you're pretty much our client, and you're small businesses. And when you have this kind of size of business, your cash flow statement really can be replaced by your bank statement. Just keep that in mind, because what happened to your bank? It is really your cash flow. Of course, if you have, like for one business, you have 10 bank accounts, then that will make you dizzy because you have to add all of the 10 together to really get a good feel of the cash flow, right? But hopefully you're not complicating your life like that, and you have one main checking account for your business. If that is the case, that is your cash flow. Okay, so now we're talking about income statement and the balance sheet. How do they interact with each other? So, a lot of our business owners will say that, well, Ying, I know what is income statement. It is my sales minus all of my expenses, and I got a profit. But I don't understand balance sheet. They are weird. I don't understand it. And the bank always asks for it. When I get audited by IRS, the IRS asks for it too. What do they do with the balance sheet? I don't pay taxes on balance sheet. I pay taxes on income statement. So those are all common understanding of the financial statement. That just means that you already have pretty good understanding on the financial statement. Now, let me share screen with you. I have a drawing board, and now I want you to follow me. And here you saw my drawing board, and I already pre-drew something to save time, but let me start writing things down. So these two boxes are income statement And this one is balance sheet. So when you are audited by IRS want to see your financial statement. They already have access to your bank statement. So as a small businesses, you probably don't need to give them cash flow because they can see it from your bank. But they do not know your income statement balance sheet, even though you filed your tax return and the income statement balance sheet you have may not match to your tax return. So IRS want to see it. But when you go for bank loan, the banker, the loan underwriter ask you for that too. So now let's break down what they are inside of the statement. So the blue area I am about to draw, and this is income. Okay, so this just represents the sales and the commissions, whatever you are making is in the nature of increase your deposit, right? So it is the sales that you got and you collect the money from the customer, that's your income. But right here, this income is what IRS would like to pay taxes, right? But before they say, okay, pay taxes on the income, they also allow you to do what? They allow you to reduce your expenses, am I right? And then after income minus expenses, that's either you made money or you lose money. There's no in between, right? You either lose money or you make money. Or of course you can break even and it doesn't lose and doesn't make, but the bottom line, that green part, it is your profit. So now look at the income. If I am IRS, I go to your bank and I will look at all the deposits, say that is your income. And then you may say, oh, no, that's not right. Because I borrowed money from my mom. Okay, she gave me 20,000 because I was so short of money. And so that 20,000 deposit, it wasn't my income. It was my what? It was my liability. So I have a payable to mom for 20,000. So you see right here, I have made the color the same for you to visually understand. Income and the liability shows up like the same thing in terms of your cash flow. Am I right? Because they're all increasing your deposit. It is very easy for IRS to come in, goes, you should have more income and you declared $100,000 total income. No, you need to declare 120K income because I see you have a $20,000 deposit. Then of course it's gonna up to you to prove that that 20,000 is not from your customer, it's actually from your mom. So hopefully you have a check from your mom and they return that loan to my son and for his broken business. So that's one of my points I want to make on the income side. So you want to be so careful to not mix these two, right? They're not the same thing. So in my firm, when we help client to do financial statement, and we are very alert to the fact that if the deposit come in doesn't fit the characters of our client's business, that is a question mark we ask client, what is that deposit? Client may say, well, I just took 20,000 out of my personal account because I shorted money that month. So we know that's not income. When we say it doesn't fit the character of the business, I mean, if you are in the retail business and if you are selling groceries, are you going to have a $20,000 deposit for one grocery purchase? Of course not, right? That is not the character of your business. Your character of business is something around $100 and with dollars and cents, and the income is coming in little by little, a lot. That is your character of income. Now, what about you are in a different business? Let's say you are in the training business, and your income is training fees that paid by your student. What if your training program lasts for a year and you start a student from July 1st to June 30th, but your tax year is from January to December? So now I have training fees here. That's my income. And I charge my student $1,000 a month. So for 12 months, they paid me what? I have one student paid me $12,000. So I deposit that money in my bank account. That's my income. Here, in reality, when you are reporting taxes, if your accounting method is accrued, you don't report 12,000 as income. You report 6,000. Why? Because the other 6,000 is here. It is called unearned. Unearned. Because by the time you reach December, you still have 6 months. You haven't even taught your trainees yet. And what if your trainee goes, sorry, teacher, I'm not taking the next 6 months class. Please reimburse me and I'm done. If you have already reported this full amount, then you over-reported. Am I right? So there you go. On the income side, you want to clearly understand, number one, yes, that's my deposit. Number two, that deposit may be not for sales, so should not be here. Number three, that deposit maybe I haven't not even earned it yet and should not be here. You need to account it properly, right? So I noticed that I lost my thing here. Let me put it back. That's my blue. So that's income. Let's look at expenses. So in business, on your income statement, of course, you account for expenses. So the IRS definition of what can be counted as expense are number one, reasonable. Number two, necessary. Of course, there's more guidance during the IRS audit, and the auditor will determine whether your expenses is reasonable and necessary. Let's assume that we are in the retail business, right? So we actually have expense. So one of the expenses I didn't list it separately is cost of goods sold. That is really an expense. I know sometimes the cost of goods sold come in between the blue and the orange, but just let's assume that is right here. Then you have other expenses like utility, rent, everything is in here. So they're all in the orange color. And you notice that I actually have this going between income statement and the balance sheet. So I actually sort of equate the expenses with the asset. So in here, the large category would be the bank, account receivable, inventory, fixed asset, right? These are most common categories inside of here. So now, your expense means that you will use the dollar directly reduce your income. So let's say if my income is 100K and I spent 90,000 on other reasonable necessary expenses, then I would be left with what? 10,000 profit. This 90,000 has something to do with asset. And I want to remind you, remember when you buy a truck, let's say you have a grocery store and you bought a delivery truck for your grocery. So that becomes your fixed asset. The truck is here. Let's say that is a $50,000. You are treating that as your equipment. So this truck, because it is a fixed asset, and it cannot be just coming over here, become another $50,000 expense. We all know that the life of the truck is longer than 1 year, and it should be depreciated. Am I right? The word we are using? Of course, there are different rules in the tax book. There are different rules. And the presidents, every president coming on board, they like to mess up on this part of the taxes because they want to implement a policy to alter the direction of the economy. Then they put in certain measures on the tax to drive human behaviors. For example, and in 2018, and President Trump put in measures to speed up on depreciation. Okay, speed up depreciation just means that when you put in $100,000 in leasehold improvement, for example, okay, and in 2018, and this particular number can become your expense right away, or half of that become your expense right away. So this is where we call that the book and the tax differences. These are typically, when we talk in that content, it is what we call the temporary difference, because eventually you will deduct it all, right? Because you use up you use up your fixed asset, you deduct it all. But there is a temporary difference. We can speed up that deduction right here, so we can get a negative profit. We don't get a profit anymore. And if I deduct 100,000, maybe I have a 90,000 loss. So right here, this is where the auditors, if IRS walk in to audit you, they will challenge you. They will make sure that on that year, when you file taxes, what tax law is allowed for you to do just for that year. Because every year could be different, right? Not exactly every year, but every 4 years is different. So they will look at that year's tax code. They will decide whether they will allow you to deduct this way or not. So in a quick summary, I want you to get the concept of you could have a lot more expenses to deduct. And if you can speed up your money that you purchased for fixed asset, right? So I just did that. And I basically let you to understand that the fixed asset is something that the tax code can manipulate. It can make you deduct faster. Now let's tackle inventory. So inventory, can I deduct all the inventory? The answer is no. If you are in the retail business, you only can deduct the inventory, the portion that you sold. That's why it's called cost of goods sold, right? So if you bought inventory for $100 and you only sold half of the inventory, then you only can deduct 50. The other 50 stay right here on asset. All right. But of course, you are a business owner. You know whether your inventory is obsolete or is still good or not. Sometimes, for example, for some stores are temporary. For example, right now, you see a lot of Halloween costume store coming up, right? So they sell costume, and after the end of October, do they still sell? They don't. So they purchase inventory for now. They try to sell it. At the end of the October, on that trick-or-treating date, if they didn't sell those things left over, that become inventory. The business owner would have to decide whether the inventory amount in here, it is still good or not. And if the business owner knows that, well, you know, these candies, you can't save them for a year, next year to sell them, so they have to be written off. Hear me? Written off. That means you bring this 50,000, you bring them back into the expense. Written off. So you can write off your inventory for those ones you can't keep anymore. But of course, maybe you have this witch outfit, it's not gonna go out of style, which is always there. And so you keep it. So it's stay on the inventory, right? Now, what about account receivable? Let's say you're in the business. Let's say you're a dental office. And you know, by December, and before you close out the year, you got 100,000 went into the insurance company and they're gonna pay you, okay? And then you have this receivable on your book. And by your experience, you know that when I submit 100,000 to the insurance company, I only get $80,000 back. So there's always like 20,000 or 20% of that. I just don't even know why. They just don't pay. You know, ever since Obamacare, the medical insurance reimbursement is a nightmare for the doctors. You know, they don't know what they're gonna get. They only can guess. So that 20% can come back here to be written off. So for expenses side, we talked about things that we can write off. We can increase the expense. And we also talked about depreciation, fixed asset rules, and that can be very different every year. That's why you need to rely on your professional tax preparers, have them look it up, see whether that is deductible or not, how much you can speed up the depreciation, right? So the higher your expenses, the lower your profit would be, and the less taxes you will pay, right? Because our tax is you use the profit times tax rate that equals to tax dollars. This is where the tax is calculated. It's on income statement. This is why a lot of folks knows how to read income statement, but not sure what's the relevancy of the balance sheet. Now you know the relevancy, because I already told you, if you have inventory, you should consider to look at your inventory at the end of the year to see whether everything is valid. If it is obsolete, if it is inventory so outdated, you know you're never gonna sell it, and then you write it off. Don't keep them on the book. For what, right? And now fixed asset. Fixed asset is something that depreciation deduction is what I called monopoly dollars, right? They're not real expense. You did not really lose it. You just depreciate it, right? But it is a real deduction. It is a real deduction for tax purposes. So that's why businesses with a large equipment, and even though they did a good business, but they still don't pay taxes. And the business with real estate developers, you know, like President Trump, okay? He paid $700 some taxes, for the last 2 decades of business. And I mean, I am pretty sure his book and taxes has a huge difference because of all of these implementations of tax advantage that is out there available to business people. All right, so now let's focus on balance sheet. Now you kind of see the orange and orange, how they work together. So if I am a bank, you come to me, goes, Ying, I want to borrow money and to do things. So what would you like to see? The banker want to see your asset equals to liability plus equity. So let's talk about the concept of balance sheet. I always tell folks that imagine the lady's purse. So in there, their lipstick, credit card, and maybe some cash. That's all. Okay, very simple. Most of ladies are living that way. So maybe face powder too, but same thing. Lipstick, credit card, maybe cash. So what is cash? Cash is the bank deposit. It's right here. So $10 cash. What is lipstick? Lipstick representing inventory fixed asset. Credit card, liability. Credit card. So let's say I have an empty purse. I bought a lipstick for $20. And one of the lipstick I paid by credit card. The other lipsticks I paid by equity. That means I have the cash, so I used it. So $10 equity plus $10 credit card debt equals to my lipstick of $20. So that's the basic of balance sheet. Now, we already talked about asset, how closely that is related to your expense. If you want to remove any item out of the asset, you literally are looking at moving that to expense because in accounting terms, they're all debit. Honestly speaking, when I was doing my accounting degree, when I was in my early 20s, I'll tell you that I really didn't understand debit, credit, what that means. I don't feel comfortable around talking like that. But right now, I am making it visual for you. The orange is debit. Okay, what about the blue? The blues are credit. So if I want to remove your liability, but I also have that bank deposit, the only way to go is to recognize that as your income or recognize that as your equity. What is the word of equity means? Equity means something you have, you did not borrow. It is really yours. Okay, let's look at what's inside of equity. See, I have 2 shades of green. The one darker means that it is accumulated over the years of the business. Or your investment. So let's go back to the example where the $20,000 was from mom. Okay, so she give you 20,000, you deposit that into your bank. IRS march in, goes, that is your income. You say, no, that is not. That is my mom's money, and it is not income. So now IRS goes, okay, so where you want to put it? Where you want to put the 20,000? So you put as a payable to mom. That's okay. IRS goes, can you give me a promissory note copy that you have between you and your mom? You go, no, I don't have it. It was a handshake And then IRS go, then can you show me and your mom's check that you got deposited? So you got to find a way to prove that is a loan. And then you went to your mom after IRS audit, and you felt really good because you passed the audit without paying any more money to IRS. So you went to your mom, goes, Mom, I am going to, I know you gave me 20,000. Mom, I know you don't need that money back because you have plenty. And can you just give that money to me? Can that be my money? So I want to wipe you out from my balance sheet. I don't want to owe you anymore, Mom. And I am just going to treat that as a capital investment. So now the 20,000 moved its position from liability to equity. Who likes that? The person who is about to loan money to you likes it because you have no more liability. Your liability is zero, or your liability is less than equity. The bank wants to see you have a very nice ratio between this one and this one. If you have $100 liability, the bank really like you to at least have $100 equity. If you don't have $100 equity, you're upside down. You got too much loan. You got too much liability. Nobody wants to loan money to you. Of course, you say that, well, Ying, I started business like long before, but I never did a balance sheet. So I'm like really, I don't even know what to do because I don't have any equity. Then I say you didn't even understand your business. If you started business, you never did balance sheet, and you started from on your own, and now you formed the company and you got a nice business going, and you did not evaluate your asset. Everything you use in your business that coming from your personal side should be evaluated, should be put on the balance sheet for the business. So after you add up all your tools and stuff, that's like $50,000. Okay, suddenly you have $50,000 fixed asset in your business. And did you borrow money to get that? No, because you had that all along, right? So that is your equity. That is your investment. So your balance sheet looks so good. You have asset 50,000, equity 50,000, liability 0. Now you march into the bank. You go, well, I'd like to borrow 10,000 to expand my business. My business has such a great way to go better, and I know how to grow it. And I already have so many purchase orders that I have on hand. The bank will do it for you because they know that you have asset. Asset equals to liability and equity, but your liability is 0. Your equity is 100%. Now, what is the dark area again? That dark area of green is accumulated over the years of the business. So maybe you're in business 5 years. Every year you make $100 profit. Then right here, it will be 500. Am I right? Because it's accumulating what you made from the prior year, but could be a negative number too if you have been losing money. But look, the light green color on here, folks, you see how profit and loss we calculated on the income statement? That got transported directly to here, or 90,000, whatever that number is. So this is the current year result. So your equity is the history plus current year. That's why I have it as a box, and I have 2 layers of color because they're not the same. Now, in our work, when we work on clients' financial statement, a lot of times, if you are writing checks to yourself, let's say I'm a business owner and I have a business, I keep on writing checks to myself. $100, $200, $10,000. And where do we book that? As in our firm, our accountant knows there is only 3 ways for us to book that dollars. The number 1 way, we book that as a business expense. They can only become business expense if the check you write yourself is a payroll check or is a reimbursement of what you paid for the company. So they will come over here. So they will reduce your taxable income. But there is another kind of check you write for yourself. It doesn't represent any expenses. It is the draw on capital. It's a draw on capital. They will just reduce your equity. So they don't reduce, they don't increase your expense. They are not related to your expense. They're coming to your balance sheet. That's why even though you go, well, Ying, I shouldn't be paying taxes. I have no profit because my bank is negative. Well, depends. Depends on whether you were writing checks to yourself and it's a capital draw or it's not a capital draw. Makes sense? I so hope that when I said that, the light bulbs goes off in your head. You go, oh yeah, I finally understand why you guys always ask us, is this capital draw? And what is this? And every time I write a check, you guys want to know why I wrote that check for. And especially if the check is under my name and you guys are just making it a question mark for me. Now you know why our accountants are so particular for what you are using your money for. Because we need to know whether we can put them under your expense, then lower your taxes, or it is your capital draw has no effect on your taxes. And if you draw too much out of your capital accumulation, you literally almost like you are putting in $10, but you draw for $100, you're going to have a $90 capital gain because you shouldn't be drawing more than what you have, right? So that is a intermediate level of understanding. But right now, for the knowledge piece, for general knowledge, not making you a professional accountant, just want you to be a really good business owner. And I want you to understand every check you write. And if it is not expense, it would either be the asset or be your capital draw. So you want to know when you write a check, when you pay money out of your bank account, where are you? Where are you putting it? Maybe you say that's asset purchase, but Ying told me that this year there is a speed up depreciation I can do. So even though it is asset, I can deduct it all, right? So this is where the planning is so important and critical for all of us. And you got to plan so you can put your dollar either here or here or here. I'm going to change my writing to a different color so we see it. So every check, I'll repeat it. Every check you write out of your business account, you are either putting money here as asset or here as expense or here as a capital draw. Every time you receive money from other places, if you receive money, deposit money in your bank, you also have 3 places to go. Number 1, it is your income. Congratulations, you made more money. Or could be the loan. You borrowed more. Or could be the money you put in to invest more. with that, I want to say that you want to clearly understand when you got a deposit, it is one of the 3 opportunities. If you wrote a check, is one of the 3 opportunities. And when you land on balance sheet, generally speaking, it doesn't impact your taxes, right? Because your tax is calculated here. But because of our blocks are so similar, see, look at here, my blue box here, coordinate with my blue box here. They are twins. I call them twin sisters. They're the same, depends on how you place them. Of course, you also have twins for the asset and expenses. They are twins too. They look similar, but they have a very different characteristic, right? Now come to our profit and loss for income statement and your balance sheet for equity. They are also twins, but they are not identical twins. They are what we call adopted twins. One is bigger, the other is smaller. The reason this one is bigger because it has a history accumulated to it. All right, so with that, I want to say that to give you a really quick summary, when you work with a bank and you want your asset to be bigger, so some of those assets, when you depreciate in tax return, and you may want to restate that by accounting standards to not have that depreciation go in as fast as your tax return. So the bank sees a GAAP standard financial statement. So you want your asset to be there. And you want your liability to be less. So if that's the money you owe to your mom, maybe have a conversation so it becomes your equity. So it's not a liability, right? And for your equity should always be bigger than the liability before that to be attractive to the bank. Of course, for taxes, and you always want to look at the orange to orange, the blue to blue, and making sure that you did not put the number in the wrong place. If you can see financial statement in this fashion, you are really a good accountant already. You're better than a lot of people who are out there doing accounting because they don't understand the connections between the boxes. But here, this is a one class to give you my 30 years experience on financial statements. So I consider it is very enlightening and very lighthearted. It's not heavy and it's understandable. And you can take a snapshot of this picture to kind of remember what we talked about. With that, I'm actually saving this one. So I will stop sharing my drawing board. And all of our webinars is actually saved on their YouTube channel. Folks do not know whether you we have a YouTube channel. Let me find my YouTube channel for you. I think it's here. See? Did you see my YouTube channel? So all of our webinar is here. So the one I'm talking about right now, it is also going to be here. So make sure that if you got a chance to really go into study, it's so useful. This particular webinar I did today, I actually asked all of our accountant in the firm to learn that as well, because I know a lot of them are really good with that already, but it is just a good summary for us to always reminding ourselves that when you write a check out from your bank account, from your business bank account, there is a 3-way to look at it, right? It can be your expense, it can be your asset, it also can be your capital draw. And then if you got deposit into your bank, there's only 3 ways that deposit would come in. Number 1 is your income. Number 2 is the money you borrowed. Number 3 is the money you invested in the company. So knowing these alternatives, that would help you a big time. And of course, all of our webinars is actually sitting here. You can come in to register. And I really think that today's content is short, but it's really useful. So I hope you enjoyed it. I will conclude today's webinar at this time. Let me quickly go off here to see whether I have any questions from any one of you out there. So, oh, maybe I didn't even share. Did I share? I just don't even know. But you understand what I am talking about. And the last thing I want to show you is a picture my daughter drew for me. This one. So let me show you this one, my dear. This one. This is a financial statement family I was talking about. You see how income statement is represent the mom, the balance sheet is the dad, and you see how these twin sisters here, that's an income, and then the other twin is liability. You see, they look alike, but their character is very different. The income, this little girl, always very happy and positive. Liability, and even though she looks like income, but she's very negative and always, you know, like people, you owe me, that kind of person, right? So look at the asset. The asset, this little boy, and this expense is the little boy. 2 of them are actually the twin, but the asset is kind of serious, like just really trying to keep things to himself. The expenses, you can tell the way he stands is like, relax, come on, let's spend whatever we can spend. Who cares? You know, you have today, don't worry about tomorrow. That's what he's doing, right? Then the adopted twin, this is equity, and this is net profit and loss. You see, she is a littler and this one is taller. They are adopted twins. They are twins, but they're not the twin. And this one has a history, right? Equity, very serious, counting on what he has, knows the history, and want to keep the family legacy, that kind of thing, right? But this net profit and loss, this girl, yeah, easygoing, and whether make money or not, it doesn't matter. So this is a picture, you know, Crystal is my second daughter. She actually, she's actually majored in animation. So I had her draw this one for me, so it can impress upon you, so you remember that. And all of what we're doing here is just to spread the knowledge, so you are as knowledgeable as me, as everyone in our firm, so we can grow our business together. And I truly believe that if we can bring out our small business owners to be a successful large business, it's such a pride. And I actually do have 2 companies come out of my hand and become a public company. And those are the purpose in this business, right? Otherwise, you know, just to do your tax return, that's too low of a goal for some companies like Community CPA. So our goal is to really make you as knowledgeable as we are, so you can run business as at least as good as we are and better than we are. All right, talk to you all again, and thank you for joining me at 3 p.m. on Saturday, and I'll see you again. Bye-bye.